Hello everyone, friends! Mozart here. I haven't had any major updates for a while. For one simple reason. The market remains sideways. Yes, we saw some kind of rebound. Again, I anticipated that it would happen. But, for now, I'm only ready to short this rebound with the aim of protecting the remaining long positions, that is, my medium-term longs in altcoins. Nothing much is happening at the moment. Technically, the market is in a rebound state, but this rebound, as I said, is within a sideways movement and is quite weak. It's unclear to me right now because on the RSI, we have a convergence, seemingly a reversal signal, but on the MACD, we don't have a convergence, we have a consistent decline. And we haven't seen this kind of pattern before the final reversal. This also happens in about half of the cases. Therefore, I don't want to do anything with the current price right now. Moreover, even on the 4-hour chart, it seems like we're breaking through the 200 moving average on the 4-hour chart. We're trying to break through it right now. But this is happening almost without any volume. There's practically no liquidity in the market right now. It wouldn't be difficult to absorb all of this back down. The other way, all of this can quickly move down. Moreover, on the CME, just a second, we still have unclosed gaps, and they're very close. Closing them is also very easy. The first ones are from Friday's close around 84,000, and there's another one here on March 13th around $80,000. So, in principle, they can also be closed without any problems and very quickly, especially considering the fact that it's approaching April 2nd, when Trump will announce this great day of America's liberation, according to his words. Again, as he says. That's why I'm not doing anything right now. The rebound can go higher, but that's not important to me. Right now, my only task is to technically take a short position higher and hold it until I either take profits from it or until I see some kind of final reversal, which for me will be at least a consolidation of Bitcoin above the mark of $93,000, or better yet above the mark of $95,000 to $96,000. Right above this high, when Trump said that the strategic reserve would definitely be there. And then he didn't say anything clear at the upcoming conference. That's what concerned the market. And now let's look at, well, the most interesting part of the review, the current state of. Accordingly, long-term, short-term holders, small, medium, large capital, what do they think and what conclusion can be drawn based on their behavior patterns after Bitcoin's drop to the marks of $76,000 to $77,000? Let's go. The first chart we have is net inflows into crypto. A chart that includes capital inflows in the form of Bitcoin, in the form of Ethereum, as well as in the form of stablecoins, which they print if demand in the markets increases. So now, just look at the green bars. This is our cumulative 30-day. By the way, this is over a 30-day period. Capital inflow or outflow if we go down, like these red zones, which often happen in bear markets. So at the moment, it has dropped almost to zero from the peak to plus $134 to $135 billion at the beginning of December 2024. 4 years. The 4. In total, a year, to just under $2 billion as of March 22nd to 23rd. Typically, this mark is the borderline before entering a bear market. That is, as soon as in the last 30 days, the net capital inflow turns into a net outflow. This is the boundary of a bear market, as long as there is no net outflow. The nearest net outflow in history was in the previous cycle of 2021, when China banned crypto. There was a net outflow here due to panic, but it was small and then quickly recovered. There was something important here, but it didn't fall. The stock market is currently falling, along with everything else, both the stock market and the crypto market, and now we have reached a state similar to the one regarding inflows. Well, this is already the post-August syndrome after the carry trade around September to October of 2024. Before Trump's victory, there were similarly low inflows over a 30-day period. That is, the market has reached a borderline phase. Although there is still a little room for maneuver for a decline, as it is not yet at zero, there is still a small space left. You can also look at the so-called hot supply. These are all fresh holders, meaning new Bitcoin holders, new buyers who have owned their coins for no more than 1 week. They have also significantly decreased from peaks of almost 6% of the total number of holders, including ETFs and everyone else, MicroStrategy, and so on. Now their share has fallen to 2%. So, if we draw this line for the entire current cycle, it is one of the lowest values. The cycle started, roughly, on January 5th, 2023, with the beginning of the growth. This is the line I'm taking, the chart from the beginning of 2023. And we see that, essentially, these are the lows. These are some lows that we have reached. And this indicates that the sentiment of new investors is extremely low. Extremely low. They don't want to enter the market at current prices. They are afraid, they are scared, and those who are holding have mostly sold off. I will talk more about this later and show in detail how much they have sold off. But for now, let's take this into consideration. That is, new wallets that own Bitcoin had held their Bitcoins for less than 1 week. Their share now accounts for only 2% of the total number of these owners. Moving on, another interesting point is open options. Well, the volume of open options on futures across all exchanges. So what do we have here? These are the bars you see on the chart. They are highlighted in different colors. Each color corresponds to a specific exchange. You can see this correspondence on the screen now, but here it's not important. Here you can look at the bottom line labeled total. This is the total volume of open options, which from a peak of $56 to $57 billion dropped to $34 billion, which is, of course, not a twofold decrease, but around 40%. There, in my opinion, even more. This is a very significant drop. For example, we had a peak in options in March 2024 at $32 billion. Then it fell to $23 billion, which is about a 30% decrease, and after that, there was this whole long-term sideways price movement. Now the decline is even greater. The drop in open interest, leverage, has been significantly reduced, and I assume that after such a reduction, the market needs some time, meaning the acceptance of a new price range, before we see further movement. The same thing happened in May 2021 when China banned crypto. There was also a very serious decline there. At the moment, from $20 to $10 billion, almost halved, also a little over 40%. And how much time did the market need? From mid-May to about the beginning of August before it continued this upward movement and updated its high. From April 2021. This is the options market. Next, the spot, ETF, market, and the futures market on CME. This is the blue, well, or light purple, in general, bars of this color. This is the change in open interest on the CME exchange. And the orange-yellow, this curved line, is the change in open interest on spot ETFs over a 30-day period. That is, with a 30-day smoothing, roughly speaking. We see, I took a special chart from the beginning of 2024, so that you can compare how significant the reduction in all positions was across all instruments, both futures and spot. That is, the market shed some of its risk by simultaneously offloading positions both here and there. Moreover, The offloading was very significant. There hasn't been a single offloading like this in 2024. Not in April-May, after the attack of Iran on Iran, nor at the beginning of July, nor during the carry trade. On August 5th, there was no such offloading. Currently, the offloading is very significant, and so far, this offloading is happening without discrepancies. And they also fell quite significantly. Crypto ETFs. This is the orange-yellow line. There were no such declines before. Since the beginning of 2024, we haven't observed this. We haven't observed it. But, overall, the history of spot ETFs is not very extensive. It has been going on for just over a year, so there's not much point in judging how bad it is. There won't be any objectivity in that. Because if this history covered at least the last 3 cycles, we could draw an analogy with fractals. Right now, that's impossible. Well, at least it would be incorrect. It's easier to judge, much easier to judge by the volume of sell-offs and open positions on the CME exchange, because we have a longer history with them. At least, the voice of NOC shows me a history from the end of 2020. The sell-off was strong. On the CME, our sell-off was strong, and it was historically strong for the entire history of this chart. That is, over 4 years. 4 years. Next, the so-called volatility smile. What does it indicate? On the left is the demand for put options. On the right, the demand for call options. So, if the left side accelerates, it means the market is hedging more against a decline. If the right side, then it's hedging more against a rise. And if we take the expirations of some distant options, for example, closer to summer, let's take May 30th, we will see how sharply the risk premium has increased. And on the left, these percentages represent the risk premium and how quickly it has increased over time. Look at the slope of these curved lines. The lines indicate the duration, well, the extent of their use, and a less steep slope. Call option premiums. That is, how much the call options have increased over time and how quickly the puts have risen. In other words, the options market has started to rapidly hedge against further decline, meaning the options market is still anticipating. At the moment, I set the expiration to May 30th, indicating the probability of reaching the price. Where is it? Currently, the peak premium is at almost $35,000, and the initial hedge of the middle line is at $60,000 to $70,000. Here, what this means is the price can come here with a high probability and here with a much lower probability. But here, the premium is substantial, and the probability of the price returning to the beginning of this hedge at around $120,000 to $140,000 is about the same as at $60,000 to $70,000. That is, this was not observed before. And you can see that the premiums have now confused the prices higher than the premiums for call options, but the expirations on May 30th. Let's look at the end of 2025. You see, it also increased very sharply and significantly, so how long did the premium grow over time? For the increase? You see how it's so gradual, the graph is gradual, the growth graph, and how quickly it rose in the West, how quickly the premium for a decline by the end of 2025 rose higher than the premium for growth, almost reaching $400,000. That is, the probability is small. Nevertheless, the premium for the risk of a decline is higher. This indicates a significant shift in the sentiments of major holders towards hedging. Not towards buying, but towards hedging. Moving on. The so-called 25% delta skew. It's not the simplest metric. I won't spend much time explaining what it means. Just keep in mind that the bumps that are pointing upwards, these are a predominance of put options, meaning options to sell, which indicates a predominance of protection against a decline. And if they, on the contrary, decrease, the market starts to relax and shift towards risk, towards call options. So, right now, Over the past year, I'll show you, we see a steady increase in the risk premium with each new peak. It surpasses the previous one, both in terms of duration. 1 month, 3 months, and 6 months. All of them are moving in exactly the same way. Each new peak is higher than the previous one. That is, with each new iteration, the market increases the risk premium against a decline. As long as this continues, the market is less likely to shift towards growth. It needs to stabilize, it needs to find the market balance, needs to understand that it is no longer under as much pressure as before, and continue this movement further, upwards, for example. Or if the pressure continues, everything will go badly. Trump will ruin the entire economy, and we will head towards a crash. So that's roughly the current state in the options markets. Options were used for hedging overall. In principle, at the peaks, we reached values. Peak values for options hedging. What about the Iranian attack? This is exactly mid-April, then the July drop on August 5th. And here was another wave closer to the marks of August 5th. We reached these peaks, but as you can see, even in the year 24, this value was reached 4 times. Now we've only reached it twice here. This doesn't mean it will be reached 4 times, but considering all the factors we have, it might be tested more times. This is the value at the hedge level. So, let's move on to the most interesting part. What losses did the market incur? And in this metric, we have the unrealized loss of short-term holders. Cohort, tenure. I remind you that in the context of blockchain, short-term holders are all Bitcoin holders who keep their coins for no more than 155 days. At its peak, our loss reached a value. What is this value? That is, how does this metric calculate? It calculates the loss. This is unrealized loss, meaning how much unrealized loss there was. Unsold losses. In short, at the moment in hand, and on March 10th, during this peak of decline, short-term holders had about 20% of their coins in loss at the peak of their total number, which they do not hold. We also have 3 lines here. Excuse me, no, even 5 lines. The average and standard deviations. Green and orange. These are -1 and +1 standard deviations. Blue and red. These are, respectively, -2 and +2 standard deviations. We are currently only interested in the orange and red lines. These are the so-called lines of maximum pain. They are especially interesting to us in bull markets, which determine the peaks and troughs of all corrections, bull markets. So, in terms of pain level, we have reached the state of August 5th. That is, we practically hit the line of 2 standard deviations. This line, by the way, historically serves as the zone that separates a bull market from a bear market. Except for major shocks, of course. So yes, if we take the situation of May 2021, that is, a serious hit to crypto, unlike the stock market, here, it is possible to break through this line. Currently, there hasn't been anything specific against crypto. And as soon as we cross this line, under normal conditions, without any force majeure situations like some kind of ban, crypto crash, exchange collapse, or COVID, it is a gradual transition into a bear market. As, for example, it was at the end of 2021, beginning of 2022. I've highlighted it here. The same thing happened in 2017. The boundaries separating the bull market from the bear market. Here it was. The situation continues to move into a bear market, but so far this hasn't happened. The losses were significant. The losses are comparable to the losses on August 5th at the moment, but we did not cross the level of double standard deviation. Upwards. All the red people, we did not cross it. That's good, that's good. This means that the market is still in a bullish phase. And even though Bitcoin has dropped by 30%, we can still move upwards from here. And I see this both in the blockchain and in the indicators right on the chart. But I mentioned this in previous videos. Where is my boundary? On the chart. The division between bullish and bearish markets for the correction was strong. Now, if we step away from all these complex recalculations and just look at the money, how much short-term investors have lost over the last 30 days at the moment they have lost? Billions of dollars. They had a net loss. Billions. That's in money. And this loss is greater for us, of course, already more than a loss. In July, August, and September-October 2024. But for one simple reason, it is greater. Because here, the price was around $60 to $65,000, and now it was around $80 to $85,000 respectively. The more expensive Bitcoin is, yes, the greater the losses will be if we sell the same amount of Bitcoin, but even with this, we haven't entered the phase of some catastrophic losses that were observed during the transition to a truly bearish market. That is, for example, here, as I already mentioned, the end of 2021, the beginning of 2022. Even there, when the price was already below $40,000, at the moment, the losses were greater than now at 70 to 80. This is the true transition into a bearish market. It was here. Here, it's just a zone of deep losses, but not a transition into a bearish market. Moving on. In addition to this, to add some optimism, so to speak, long-term holders, long-term, smart money, whatever you want to call them. A binary indicator, which I often showed you before, I'm showing it now too, in a slightly different interpretation, but the meaning doesn't change. This line, well, the curve that shows the amount of holdings by long-term holders of their Bitcoins. You can see how they were selling off here, selling off and around. End of February, they started accumulating. This is not a quick process. They don't immediately turn the market around as soon as they start accumulating. So, this doesn't happen quickly. Here, they also started accumulating, somewhere around April 2024, during the first dip after the Iranian attack. And, before the next rise, they accumulated for quite a long time before Trump's victory. A considerable amount of time passed. It doesn't mean that the same amount of time will pass now. Just keep in mind, they don't turn things around quickly. Trend. The fact that they stopped the selling pressure, yes, that's true, and it's good for the market. Plus, these so-called shadows from below show how many days within a 15-day window long-term holders are selling their coins. We also have here +1 standard deviation with green lines and -1 standard deviation with red lines. But at the peaks, we often hit this +1 SD. And now that's it. We see that the binary grid has disappeared. Here we have a plateau, a white zone. We see that the pressure from long-term holders has stopped. At these levels, they no longer want to sell. And, moreover, there is a metric. The so-called strong pain for long-term holders, which shows the level of their sales when they equally leave with a profit, but take chips off the table when they feel a high risk in the market. That they might even end up not just with zero, but even with a loss. And these red bars that are highlighted indicate those very events when they leave with a profit. But they still leave the market. This happened to us. At the moment when Trump announced the creation there. Yes, that he would definitely create a Bitcoin reserve, and also add Cardano, Ripple, Solana to it, and much more. Before that, they took chips off the table after Trump's victory. Not at the very peaks, but close to them. And, before that, they took chips off the table after the July dump, and after the August dump. That is, these values scared them. They were scared. And now this value, it scared them too. As a rule, there are usually two such bars. As a rule, they don't exit on just one. 1, 2, 3 were here. 1, 2, 1, 2. So far, there has been only one bar. Therefore, these two waves, the second wave, is still very likely. That's why I'm not doing anything right now and not going all in at current prices, specifically in terms of additional medium-term positions. And I'm waiting for some kind of resolution. And the last chart is the cumulative realized profit of all long-term holders broken down by cycles. Here is an interesting metric. This profit, these columns, like columns, these cliffs, yes, the first cycle in 2013, red, thin, 2017 blue, 2021 green, and now black, the fourth cycle in terms of profit. It shows the value not in dollars, but in bitcoins. So how many net bitcoins did long-term holders receive as profit? Well, for example, throughout the entire last cycle of 2021, they received 3,050,000 bitcoins in net profit. At the moment, they have received 2.5 million bitcoins so far. And in 2017, they received almost 4 million bitcoins in net profit. What's interesting is that this same line I just showed you, it indicates how many coins are on the balances of long-term holders. And if in previous cycles we saw these balances decrease, well, if not to zero, then quite deeply, at this stage it has remained at the level, to be precise. Well, it's roughly half from the peaks. It has halved from the peaks. Whereas in the last cycle, it decreased 4 to 5 times. Further, 0.77, 0.05, more than 10 times. So, overall, long-term holders haven't sold off that much. That is, I assume this is not the end yet. Cycles. I've already mentioned that from my point of view, they will be stretched over time. And such behavior of long-term holders indicates that most of them are still, so to speak, with chips on the table, and they are still waiting for this transition. I assume that these are not the dumbest holders and not the dumbest money who understand a little, and they probably have a better idea than us about what will happen to the market next and at what prices they are ready to exit. This doesn't mean it will happen tomorrow. It doesn't mean it will happen in a week or even in a month, but with a high probability, it will still happen. Just now, again, summing up everything I've told you and looking at the daily chart, Bitcoin needs to find a balance. Balance in what range? I will now roughly show this range, which is significant for me. And upon exiting this range, we will either see a continuation of the bull market or a definitive shift to a bear market. This is the zone of uncertainty for me personally right now. That is, the upper, probably this upper boundary, which is approximately $94,000 to $97,000. If we go higher, we continue the bull market. The lower boundary, for me right now, it's approximately these highs, the beginning. It's approximately 73 to 60. But not to be exact, up to $67,000, that's the lower boundary if we go below it. This indicates a shift to a bear market both on the chart and according to all on-chain metrics, respectively. This wide range, unfortunately, is broad because I analyze the daily chart. I don't work intraday. I can't enter from the top and bottom because I don't work with scalper timeframes. Specifically in crypto, I work here with the daily and weekly charts, so for me, it's roughly from here to there. This is the zone of uncertainty. And here I'm ready to go long from the bottom and short from the top, shorting to protect my medium-term positions remaining in altcoins and going long on moments and metrics of the transition from a bull market to a bear market. At moments where there will be maximum protection from long-term holders. And, in principle, from the objective market. That's all. This is my conclusion now. I will end on this note. So, quite a bit of time has passed. If you like this review, hit the like button. I will understand that you are interested in this format, and I will try to do it more often and in more detail. Thank you all. Have a great day. This was Mozart, and goodbye to everyone.